The most powerful weapon in history isn't a bomb. It's a piece of paper with dead presidents on it. For 70 years, the United States has controlled the global economy not through military conquest, but through something far more sophisticated, making every country in the world dependent on American currency. Oil is priced in dollars. International trade settles in dollars. Central banks hoard dollars. And if you want to participate in the global economy, you need dollars. This isn't how currency is supposed to work. Currency is meant to be a tool, a medium of exchange, not a weapon, not a control mechanism. But the dollar became both. And the system that made it indispensable also made escape nearly impossible. Countries have tried. They've failed because the handcuffs aren't visible. They're woven into the structure of global finance itself. Welcome to The Financial Historian, where money, power, and history collide. And nothing is ever as simple as it looks. Act 1. How it happened. Bretton Woods. In 1944, while World War II was still raging, representatives from 44 countries met at a hotel in Bretton Woods, New Hampshire. The goal was to design a new international monetary system. The previous system, based on gold and competing currencies, had collapsed in the 1930s, contributing to the Great Depression and the conditions that enabled war. The new system needed stability, predictability, a way to facilitate international trade without the chaos of fluctuating exchange rates and competitive devaluations. The solution was elegant. Tie all currencies to the US dollar and tie the dollar to gold at a fixed rate of $35 per ounce. Every country would peg its currency to the dollar at a fixed exchange rate. The US would guarantee to convert dollars to gold on demand, and international trade would flow smoothly because everyone knew what their currency was worth in dollar terms. This was sold as international cooperation, a system benefiting everyone. Stable currencies, predictable trade, shared prosperity. And it was all those things, but it was also something else. American dominance encoded into the global financial architecture. The privileged position. Under Bretton Woods, the dollar became the world's reserve currency. Reserve currency means central banks hold it in reserves. International contracts are denominated in it. Trade settles in dollars. It's the currency everyone accepts because everyone else accepts it. This gave the United States an extraordinary advantage. When other countries needed to import goods, they needed dollars to pay for them, so they either had to export to earn dollars or borrow dollars from international markets. But the United States could simply print dollars. American deficits didn't matter the way other countries' deficits mattered. The U.S. could run trade deficits, buying more than it sold, without the currency crisis that would destroy other economies. Because the world needed dollars, the U.S. could create them. This is called exorbitant privilege, the ability to finance consumption and investment by printing currency that other countries are forced to accept and hold. The gold constraint. The system worked as long as the U.S. maintained the gold link. As long as other countries believed they could exchange their dollars for gold, they accepted dollars as trustworthy. But by the 1960s, the constraint was becoming problematic. The U.S. was spending heavily. The Vietnam War, the Great Society programs, foreign military bases, international aid, all of this required dollars flowing out of the U.S. More dollars circulated internationally than the U.S. had gold to back. Countries started getting nervous. France, under Charles de Gaulle, began exchanging its dollar reserves for gold. Others followed. The gold was draining from Fort Knox, and the U.S. faced a choice: cut spending to preserve the gold standard or break the gold link. The Nixon shock. In August 1971, President Nixon announced the U.S. would no longer convert dollars to gold. The Bretton Woods system was dead. The gold constraint was removed. The dollar became a fiat currency, backed by nothing except the U.S. government's promise. Most observers expected chaos. Without gold backing, why would anyone trust the dollar? Why would countries continue holding reserves in a currency whose supply could be expanded infinitely? The answer came quickly. Because there was no alternative. The global economy was already structured around the dollar. Oil contracts were in dollars. International debt was in dollars. Trade relationships assumed dollar settlements. Switching would require rebuilding the entire architecture of global trade, and no one had the power or coordination to do that. So the dollar remained dominant, not because of gold, because of inertia, because of network effects, because everyone used it, so everyone had to keep using it. Act 2. The petrodollar system, the oil linkage. After abandoning gold, the U.S. needed something else to anchor dollar demand, something essential, something every country needed: oil. In the 1970s, the U.S. negotiated agreements with Saudi Arabia and other OPEC countries. The arrangement was straightforward. Oil would be priced and sold exclusively in dollars. This wasn't just a pricing convention, it was structural. If you wanted to buy oil, and every industrialized country needed oil, you had to first acquire dollars. Even if you were Japan buying oil from Saudi Arabia, the transaction happened in dollars. This created constant global demand for dollars unrelated to trade with the United States. Countries needed dollar reserves just to purchase energy. The petrodollar system turned the dollar into the world's energy currency, and energy is the foundation of modern economies. The recycling mechanism. The system created a flow that benefited the U.S. enormously. Oil-producing countries earned vast dollar revenues. They couldn't spend it all domestically, so they recycled those dollars by purchasing U.S. Treasury bonds, investing in American assets, or depositing in banks that lent to U.S. borrowers. The dollars flowed out to buy oil, then flowed back to finance American debt and investment. The U.S. could run persistent trade deficits without consequence. The dollars spent on imports returned as investment in U.S. assets. The American government could borrow cheaply because foreign central banks were eager to hold dollars. It was a self-reinforcing cycle. The more oil trade happened in dollars, the more countries needed dollars. The more they needed dollars, the more they invested in dollar assets. The more they invested, the more the U.S. could borrow and spend. The enforcement mechanism. The petrodollar system wasn't purely voluntary, it was enforced. When countries tried to price oil in other currencies, the U.S. responded, sometimes diplomatically, sometimes economically, sometimes militarily. Iraq, under Saddam Hussein, announced in 2000 it would sell oil in euros instead of dollars. By 2003, Iraq was invaded. The oil sales returned to dollars. Libya, under Gaddafi, proposed a gold-backed African currency for oil trade. In 2011, NATO intervened in Libya's civil war. Gaddafi was killed. The currency plan died with him. Iran has attempted to sell oil in currencies other than dollars. It faces comprehensive sanctions that lock it out of the dollar-based financial system. The pattern is consistent. Countries that seriously threaten the petrodollar system face consequences. The severity varies, but the message is clear. The dollar's role in energy markets is not negotiable. The broader commodity system. Oil was the most important commodity priced in dollars, but the system extended to most internationally traded goods. Copper, wheat, coffee, minerals, industrial inputs, all priced in dollars on international markets. This meant every country needed dollar reserves not just for oil, but for any international commodity purchase. The dollar became the universal medium of exchange for the global commodity market, and commodities are essential. Countries can't simply stop importing food, energy, or industrial materials without economic collapse. So the dollar moved from being a convenient common currency to being a necessary one. Not using dollars meant exclusion from international commodity markets.
Act 3. The Financial Architecture. The SWIFT system. In 1973, the Society for Worldwide Interbank Financial Telecommunication, SWIFT, was created. SWIFT is the messaging system that banks use to communicate about international transfers. When a bank in Japan sends money to a bank in Germany, they use SWIFT to coordinate the transaction. SWIFT itself doesn't move money, it's just the communication layer, but it's essential. Without SWIFT access, banks can't make international transfers. And SWIFT is denominated in dollars for most transactions. Even when the transaction is between two non-American banks in non-dollar currencies, the messaging often involves dollar conversion. More importantly, the U.S. has influence over SWIFT. Belgium hosts the system, but the U.S. can pressure SWIFT to disconnect countries from the network. When Iran was cut off from SWIFT in 2012 as part of sanctions, Iranian banks couldn't receive international payments. Iran couldn't sell oil to most customers. The Iranian economy contracted severely. SWIFT access became a weapon, and that weapon is tied to dollar compliance. The correspondent banking system. International banking relies on correspondent relationships. If a small bank in Vietnam wants to send dollars to a company in Brazil, it doesn't have a direct relationship with Brazilian banks. Instead, it uses a correspondent bank, usually a large American or European bank that has relationships everywhere. The correspondent bank facilitates the transfer, acts as intermediary, and charges fees for the service. But here's the key. Correspondent banks can refuse service, and they refuse when the U.S. tells them to. If the U.S. sanctions a country, American banks won't provide correspondent services to banks in that country. And because American banks are central to the international dollar system, losing access to them means losing losing access to dollar transactions globally. This gives the U.S. enforcement power over international finance without needing military occupation or political control. Just deny dollar access, and the target country is locked out of global trade. The reserve currency trap. Central banks around the world hold dollar reserves. Approximately 60% of global foreign exchange reserves are in dollars. They hold dollars for several reasons: to stabilize their own currencies, to pay for imports, to service dollar-denominated debt, and because everyone else does. But holding dollar reserves means buying U.S. Treasury bonds or other dollar assets, which means lending to the U.S. government and American entities. This creates a perverse dynamic. The countries that are most wary of American power are the ones financing American deficits. China holds over $1 trillion in U.S. Treasury bonds. Japan holds similar amounts. They're not doing this out of generosity. They're trapped. If they stop buying treasuries, the dollar weakens, which makes their existing dollar holdings less valuable, and it disrupts their export-oriented economies that depend on stable dollar exchange rates. They can't escape without harming themselves. That's the trap. The debt dollar. Much of the world's debt is denominated in dollars, not just government debt, corporate debt, infrastructure loans, development financing. When Argentina or Turkey or South Africa borrows, they often borrow in dollars because interest rates are lower and investors demand it. But this creates currency risk. If their local currency weakens against the dollar, the debt becomes more expensive to service. Countries can find themselves unable to pay not because they're bankrupt, but because their currency depreciated. This gives the U.S. indirect control over debtor nations. If the Federal Reserve raises interest rates, dollar-denominated debt becomes more expensive globally. Countries face a choice: raise their own interest rates to defend their currency, causing domestic recession, or let their currency weaken and face a debt crisis. Either choice serves American interests. Higher foreign interest rates reduce competition with American assets. Debt crises create opportunities for American investors to acquire assets cheaply. The dollar isn't just a currency, it's a control mechanism embedded in global debt structures. Act 4. The escape attempts. The Euro challenge. When the Euro launched in 1999, many predicted it would challenge dollar dominance. Europe's economy rivaled America's. The Euro represented a large, stable economic bloc, and European leaders explicitly discussed reducing dollar dependence. For a while, it seemed possible. The Euro gained some reserve currency status. Some commodities began pricing in euros. Oil trades occasionally settled in euros. But the Euro never seriously threatened the dollar, for several reasons. First, Europe lacks political unity. The Eurozone isn't a single country. Fiscal policy is fragmented. This makes the Euro less reliable as a reserve currency because its stability depends on consensus among nations with different interests. Second, Europe lacks deep financial markets. The U.S. has massive liquid treasury markets where central banks can park trillions in reserves. Europe has no equivalent. Third, the U.S. actively defended dollar dominance. As mentioned earlier, countries that moved oil sales to euros faced consequences. The euro remains important regionally, but it never displaced the dollar. The Chinese renminbi. China has been more deliberate about challenging dollar dominance. China launched renminbi-denominated oil futures contracts. It established currency swap agreements with dozens of countries, allowing trade in renminbi instead of dollars. It created the Asian Infrastructure Investment Bank as an alternative to dollar-dominated World Bank. And China started pricing some commodities in renminbi, encouraging countries to hold renminbi reserves, building infrastructure for renminbi international settlements. But the renminbi faces obstacles. China maintains capital controls. You can't freely move money in or out of China, which makes the renminbi unattractive as a reserve currency because central banks need liquidity and freedom to move assets. Chinese financial markets are less transparent and less trusted than American markets. There's political risk. The Chinese government could change rules arbitrarily. And China's economy, while large, isn't dominant enough to force a currency transition. Countries can't ignore U.S. markets the way they might ignore smaller economies. So the renminbi gains ground slowly, but it hasn't broken dollar dominance. The cryptocurrency fantasy. Some believed cryptocurrency could provide an escape from dollar dependence. Bitcoin, Ethereum, and other cryptocurrencies are decentralized. No single country controls them. They enable peer-to-peer transactions without correspondent banks or SWIFT. In theory, countries could trade in cryptocurrency, bypassing the dollar system entirely. In practice, cryptocurrency faces massive obstacles. Volatility makes it unsuitable for pricing commodities or holding reserves. You can't run an economy on a currency that might lose 20% of its value in a week. Scale is insufficient. Crypto markets are tiny compared to the dollars needed for international commerce. And governments can ban it. China did. The U.S. could regulate it into irrelevance domestically, and other countries would follow because they need access to American markets. Crypto might enable some sanctions evasion, small-scale trade, but it can't replace the dollar system for serious international commerce.
The BRICS initiatives, Brazil, Russia, India, China, and South Africa, the BRICS nations, have repeatedly discussed creating alternatives to dollar dominance. They proposed a BRICS currency, a BRICS development bank, mechanisms to settle trade in local currencies. But BRICS faces fundamental problems. These countries have divergent interests. Brazil and China are trade competitors in many sectors. India and China have border disputes. Russia and China have historical tensions. Building a shared currency requires trust and coordination that doesn't exist, and it requires infrastructure, clearing systems, financial markets, legal frameworks that takes decades to build. Most importantly, most BRICS countries still need dollars. They can't simply abandon the system without economic pain. So, BRICS initiatives remain mostly aspirational, announcements without implementation, plans without execution. The network effect. The dollar's dominance is self-reinforcing. Because most trade happens in dollars, businesses keep dollar accounts. Because businesses use dollars, banks develop dollar expertise. Because banks offer dollar services, countries hold dollar reserves. Because countries hold dollars, they have incentive to maintain dollar stability. Each participant in the system benefits from the system's existence, which makes coordinated exit nearly impossible. Switching to an alternative currency would require convincing thousands of banks, millions of businesses, and dozens of central banks to change simultaneously. The coordination problem is insurmountable. This is network effect, like Facebook or email. The value is in universal adoption, and once achieved, displacement becomes almost impossible. The infrastructure lock-in. The physical infrastructure of international finance is built around the dollar. SWIFT, correspondent banking, clearinghouses, legal frameworks, accounting standards, all optimized for dollar transactions. Rebuilding this infrastructure for another currency would take decades and cost trillions, and it would need to happen before the alternative became viable. No country or bloc has the resources or coordination to build parallel infrastructure from scratch. China is trying, but even China's efforts are gradual and limited because the cost of building alternative infrastructure is enormous and the benefits are uncertain. The American enforcement. The U.S. actively defends dollar dominance, not just militarily, economically, diplomatically. Countries that threaten the system face sanctions, financial isolation, lost access to American markets, pressure on allies to join embargoes. The U.S. has demonstrated willingness to use financial weapons, freezing Afghanistan's dollar reserves, cutting Russia from SWIFT, sanctioning Iranian banks. These actions teach a lesson. Challenging the dollar system is costly, potentially regime-threatening. So countries tread carefully. They may diversify reserves slightly. They may experiment with bilateral trade in local currencies, but they don't directly challenge the system, because the U.S. has made clear that dollar dominance is a vital national interest, and the U.S. has the power to enforce that interest. The prisoner's dilemma. Every country would benefit from escaping dollar dominance collectively, but no country benefits from escaping alone. If one country abandons dollars, it loses access to international markets while others continue trading normally. The cost is borne individually, the benefit is collective. This is a classic prisoner's dilemma. Coordination would benefit everyone, but individual incentive pushes towards defection, continuing to use dollars. And the U.S. exploits this by making bilateral exceptions, offering selective access, creating divisions. Countries compete for American favor rather than cooperating to challenge American power. The uncomfortable truth. The dollar system isn't maintained primarily through American strength. It's maintained through everyone else's weakness. Europe is politically fragmented. China maintains capital controls. Other countries are too small. No one has the combination of economic size, political unity, and financial infrastructure to offer a credible alternative. And as long as no alternative exists, the dollar remains dominant, not because it's the best currency, but because it's the currency that offers access to the full global economy. This is why countries can't escape. The handcuffs aren't locked by American force alone. They're locked by the absence of alternatives, by coordination failures, by infrastructure dependencies, by the simple fact that replacing a global system is harder than enduring it. The dollar became a weapon not through conquest but through indispensability. The United States designed a system where participation in the global economy requires dollars, where opting out means isolation, where challenging the system invites consequences. Countries recognize this, they complain about it, they discuss alternatives, but they continue using dollars because the cost of exit exceeds the cost of submission. The handcuffs are invisible, made of infrastructure, network effects, and coordination problems, but they're no less real than physical chains. Understanding this isn't about blaming America or romanticizing alternatives. It's about seeing how power operates through systems rather than soldiers, how currency can bind more effectively than treaties, how indispensability is the ultimate form of control. The Bretton Woods architects in 1944 might not have intended to create perpetual American dominance, but they created a system whose logic led inevitably to it. And once established, that dominance became self-perpetuating, not because the dollar is special, but because the system makes it impossible to imagine functioning without it. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.